Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable.
A guest on the show today is Tal Keinan, the CEO of Sky Harbor Group, a publicly traded developer and operator of airplane hangars. Before conducting the interview, I had the opportunity to learn a lot about Sky Harbor from an investor friend who owns the stock and knows the company as well as just about anyone else on the planet. That led to a deep, rich conversation where we covered the process by which Sky Harbor became public, whether Sky Harbor is a real estate company, an operating company, or both, an overview of the supply and demand dynamics for business aircraft hangar space, how Sky Harbor views the threat of emerging competition, and the economics and returns associated with developing new hangars. For full disclosure, I am not a Sky Harbor shareholder. And without any further ado, here's my conversation with Tal Keinan of Sky Harbor Group.
Tal, Sky Harbor is likely a company that is new to a lot of investors. Could you talk about the process by which this company came public?
Sure, Ben. So this came out of really my personal story, personal experience. I continued flying civilian after I got out of the military, and in 2015 I was able to actually purchase my first aircraft. I was on Wall Street at the time. That I actually bought that airplane in Australia, and I only started looking for hangar space after arriving in New York with the plane. I found myself kind of in this panic. There's I'm waiting list at 12 different airports around New York City. There's zero hangar space available. I got very lucky. Somebody sort of graciously helped me out in a month-to-month hangar that I was actually in until the earlier this year, since 2015. Finally moved to a different space, but it did leave me curious. What's going on here? You've got an industry that funnels a lot of capital through it. You'd think that the market would take care of any sort of supply-demand mismatch like that, and became very clear. As I started looking into this, really just as a curiosity. This wasn't a business idea. That this is a chronic structural issue in business aviation in the United States. It's true in other jurisdictions as well, but we're interested in the United States. It's totally common knowledge. I was kind of the last person to get the memo on that. It was very, very well known in the industry. It's probably the least controversial statement you could make in business aviation is that there is a structural chronic deficit of business aviation hangar space. So I took some time off to write, and the guy who we actually installed as an interim CEO at my company was better than I was. So it was clear I wasn't going to go back there full time. I remained active on the board, but not full time. I said, I've been really, really, getting increasingly curious about this hangar opportunity. We could talk about it later. There's a qualitative opportunity as well, but the qualitative is really kind of the big driver of this business. There's simply just a gaping deficit of many millions of square feet. So we started the company in 2018. We went public in 2022. Through a SPAC merger, a SPAC managed by Boston Omaha, and that was as long as we're on. I mean, I would say the fundamental problem is that lack of space. Again, if we have time at the end, happy to kind of explain what our thesis is as to why that came about and what's kept it, what's perpetuated that issue for really decades now. It's just becoming more acute. That's your sort of need to have problem. There's a want to have problem as well, which is the sort of legacy business model for business aviation hangar space, which is the FBO model, the fixed base operator model. Is really, I think you can think of it as a hotel. where you can live, right? But FBOs are primarily structured to fuel transient aircraft. That is their kind of primary function. You can live at the hotel, and that's what the vast majority of people do today, but it's not necessarily ideal for every flight department. There are those for whom I think it's fine, it works just fine, and there are others for whom having a home actually makes makes a lot of sense. And again, I'm sure we'll talk about this, but as as we kind of got deeper in and really began learning our own business in a more profound way, it became clear that you need to fuse the real estate and the service offering together. That's got to be planned from the start to create something that's actually quite unique and solve that want to have problem. Again, we could keep going with the legacy model, but there is a better way for a lot of the aviating public.
And I think anyone who would be potentially interested in investing in this company would want to understand those structural, historical reasons for the undersupply. So maybe you can talk a little bit about what your thesis is behind, and maybe even looking backwards and forwards of why there has been such a lack of supply, and then how do you even solve that problem?
Sure. So this problem begins in the 1930s, where the federal government builds 13,000 airports across the United States. And at the time, you didn't have a big enough aviation industry to justify that sort of infrastructure project. This was really a New Deal employment scheme more than serving a critical infrastructure need. Bless you. So you end up with this surplus of airports across the United States. And that actually ended up serving us well during the war, in that the U.S. was able to out-train everybody on pilots. The U.S. Army Air Force and the U.S. Navy were putting out pilots at a rate even faster than the Soviets. And your bottleneck in training pilots is runways. That's what you need. The airplanes, we were making hundreds of thousands of airplanes a year during the war. Instructors, you can mint almost as quickly as you can mint pilots. It's runways. That's the bottleneck. So that's actually an interesting story in itself, but not for us. But after the war, that system, as a system, fell into irrelevance. Again, and the federal government, by necessity, has to think in kind of broad terms. You're not looking out and saying, okay, Republic Airport on Long Island is interesting. That's an airport that should stay in the system. And, an airport that doesn't get much use in North Dakota, not so interesting. The entire system was divested of, and all of the airports were handed over to local governments. So today you're in a situation where almost every airport in the country is owned by a municipality or a county. There are a few airports that are owned by states. There are no federally owned airports, and there are virtually no privately owned airports. That's who owns the airports in the country. And local government tends not to run huge cash surpluses. So the investment in the airport, it has been kind of neglected. Now, decades ago, that became very evident that these airports, particularly what we call general aviation airports, versus commercial airports, which is a regulatory distinction that we can talk about as well. Those airports are not self-sufficient financially. They contribute, they can contribute massively to economic development in a region, for sure. But as standalone entities, they don't make money. They can't really make money. Commercial airport can make money from landing slots, automobile parking fees, concessions, especially after 9/11, where there's a much longer gap or time window between security and boarding. You kind of have a captive audience in a mall. So there are definitely ways to make money at a commercial airport, of which there are 489 in the country. But the general aviation airports can't really make money. They require federal subsidies in order to subsist. So there's about 3,000 airports in what's called the Airport Improvement Program, which is an FAA-administered program that provides the critical infrastructure that keeps an airport functioning as an airport. Anything that has to do with a runway, that could be a runway extension, occasionally a new runway, a runway resurfacing, any kind of maintenance on runways, that's federal dollars. Major taxiways, federal dollars. Taxiways that intersect runways, federal dollars. But that does not include things like hangars. Hangars are not in the AIP program. Now, the municipalities and counties typically have an incentive in having hangars on the airport, because if you want to capture maximize the economic development benefit of an airport, you typically want large business jets to base there. There are jurisdictions, like Texas, California, Virginia, where there's an ad valorem tax on aircraft, which is a very significant, actually often the biggest direct revenue driver that an airport has. But even where you don't, like in New York, where there is no ad valorem tax on aircraft, the economic development benefits of having aircraft based at your airport, that's jobs, that's driving local businesses from the gas station to the dry cleaner to the caterers to maintenance shops. You want those airplanes at your airport, and they're only going to come to base with you at your airport if you have hangars. So what has the kind of solution that the industry's sort of defaulted into, and this has been the case for decades, is that the airport sponsors, those cities and counties that own the airports, will confer fueling rights on FBOs, fixed base operators, the largest two chains of which are Signature and Atlantic. Those are the companies that I described earlier as hotels for aircraft. They make their money from fuel. And what an airport sponsor will typically do is impose a certain minimum amount of construction of new hangar on the airport in order to confer a fuel license onto an FBO. What's ended up happening though is the FBOs typically have a lower square footage target than the airport sponsors have. Again, they make their money outdoors. You're not allowed to fuel an aircraft indoors. That's a fire code issue. So you're making your revenue on the kind of the black area behind me, not inside the white area. We make our money indoors. They make their money outdoors. So you end up in a situation where less hangar gets built than is actually needed. And there's all sorts of solutions. Again, there's a kind of a bit of a moral hazard, a problem in the industry. There are all sorts of solutions that that kind of benefit the current players. They don't necessarily benefit the aircraft owners or the taxpayer for that matter, but they do benefit a lot of the players, like repositioning. So if you think of Manhattan-based aircraft owners, they might fly in and out of Teterboro, but in most cases the airplane doesn't live at Teterboro. The airport might live at in Bradley, Connecticut, or Bridgeport, Connecticut, or Lehigh Valley, Pennsylvania, and will reposition into Teterboro to pick up their customer. So if you're in the fuel business, that's a good trend. Because repositioning flights consume a lot of fuel. They're conducted at low altitude. If you are the aircraft owner, that's pretty expensive and it's logistically challenging. You need to manage crew hours. If you're flying to Europe or Asia from Teterboro, you've got a certain number of hours that your crew is allowed to be on duty. If they started their day in Trenton, New Jersey, repositioned to Teterboro, had a let's say 90-minute to 2-hour turnaround time at Teterboro, that's eating significantly into their hours. So on long haul flights, you might need an extra crew. It's logistically challenging, and it's also it wears on the system. Air traffic control is particularly in these congested markets has to manage 4 operations for every round trip rather than 2 because the airplane's not based at the airport that it's operating out of. So kind of put all that together. That's really where your deficit comes from. And up until now, I don't think there's really been an incentive to address that. But if you approach it as a real estate company, you actually do have an incentive to address it. And it turns out that can actually be a pretty good business model.
And if we're just thinking about the TAM here for you, for those of us who still fly coach, give us a sense of the current state of supply and demand for private and business aircraft hangars.
So it's an interesting question because you can count the number of aircraft, and we do, right? You can count the square footage of aircraft, and that's really for us the best proxy for demand. So we track that, right? Number of aircraft times length times wingspan. And what you see is this is not a new problem in the industry, but in the 10 years before COVID-19, we added about 30 million square feet of airplane. to the U.S. business aviation fleet, right? So, and that's net, right? That's new entrants minus retirements from the fleet. So it had been growing at about 3 million square feet per year. By the way, I don't know that anyone else counts this because I don't think anyone else really cares about that particular metric. But to us, number of airplanes is not really the whole story. The fact that airplanes, get longer every year, their wingspan gets wider every year, and actually critically, their tail height goes up every year. Every single year, airplanes get bigger, means that the square footage is actually growing faster than the number of aircraft in the fleet. Since COVID-19, there's been a massive surge into business aviation, both on the corporate and the private side. The backlogs are extremely long at the aircraft manufacturers. There's a huge weighting toward the large, wide-bodied aircraft. So again, the square footage is going up. I don't know exactly how much. We don't have data for the last couple of years. We will eventually, but it's clearly north of 3 million square feet per year now. Supply is much more difficult to gauge, right? So we actually count the number of hangars in an airport and in a metro center that we're interested in, and we keep that very proprietary. I don't think anyone else has that data. But what's important is the national number, the national measure of hangar square footage is not really as relevant as the square footage of aircraft, because hangars that are built in places with lower relevance. I'm not trying to pick on North Dakota. I keep using that euphemistically as a place where there's less demand, but I think empirically that is the case. A hangar in North Dakota it should be counted very differently from a hangar in the New York City area, right? Basically southern New Jersey to northern Connecticut is the New York City area for aviation. That's really what's interesting to us, right? The airplanes they're mobile assets by definition. They will go to where they're the most relevant. Hangars are where they are. And so whatever deficit we had 10 years ago, it's a lot more acute today. And we think the pace at which it's getting more acute is growing. So 10 years from now, we think that that's even more the case.
I think this would be a good time to dig into the business model, but I'd love for you to answer the question about the business model within the context of, is this a real estate company, an operating company, or both? Love to hear your thoughts there.
Yeah, so had you asked 5 years ago, I would have said we're a real estate company or a real estate infrastructure company. Today, I have to say we're both. And that's not exactly by design, but I think it does open a couple opportunities. We're a real estate infrastructure company in that, look, what we do fundamentally, we acquire land, we develop our campuses on that land, and we lease them out to corporate, private, and some government residents. So, and our revenues are measured in rent. That's the vast majority of our revenues. We do other things, but rent is really the lion's share of it. We measure our unit economics in terms of yield on cost. We're like a real estate company in that respect. We did realize early on, however, that in order to really be as relevant as we can be to our tenants, our residents, we have to offer services, and that includes fuel. Right? We can't be subject to somebody else's fuel pricing on a field, because whether they do or not, and maybe they don't always, but aircraft owners should consider their total cost of basing an aircraft, which has two big components, which is the rent you pay for your hangar space and the fuel that you consume. So if those are being bundled, then it's very important that we have a handle on both in order to provide the highest value to the residents. We saw that originally as just kind of a necessity, kind of like, you can't get into the cold storage business if you don't have access to, consistent power supply. I mean, that's that same kind of thinking. But that's evolved into something very different, is that our service offering has become perhaps one of our biggest differentiators. Now, they're tied together in that you can't really provide our service offering without controlling the real estate, right? You've got to be able to design the hangars and, just as importantly, design the campuses themselves in a way that allows you to provide this very, very specific, proprietary service package, which we think is a very big differentiator. So I'm glad we actually are having this discussion today, because I'm allowed to say now, we announced actually our first brownfield acquisition, which is at an airport in California. It's called Camarillo. It's just west of Los Angeles. What allows us to really make that work? It's a great facility. It happens to line up in terms of just the physical architecture of it with the Sky Harbor model. We can totally roll out our service at this new facility and really completely change the offering. So I would say we have become, in many ways, an operating company, a service company. When I think down the road, what does this look like? And people often ask about exit. We don't really think about it in such precise terms, but this might be two companies down the road, right? This could be a real estate portfolio, which at that point would be probably structured as a REIT, and then a service company layered on top of that is perhaps providing this suite of services in locations that are not necessarily Sky Harbor. Again, that's way down the road, but it clearly has become a big focus for us, and it wasn't at the beginning.
So we're going to dig into the economics of building a hangar in a minute, but I want to ask one question first, which is about the supply of land. So this is a real estate company. You are trying to procure land in potentially areas where there's not a lot of extra land, where they've built runways and other things, and there's not a lot of room for hangars. So how do you get comfortable that there's enough land at the airports you want to be at to be able to build new hangars?
All right, that's a great question. Developable land, it's not just land, it's developable land, because there's a lot of regulatory hoops to jump through if you're going to be developing on an airport. Developable land is absolutely constrained. You're right. We look at the question from the bottom up, though, right? This is not a question of looking at a map of the country and trying to gauge or predict how much land there will be at the average airport. It's very, very specific airports, right? So we have a database with hundreds of airports across the United States. We built it years ago. We're growing it constantly, but that database includes the specific land that we're targeting at every identified airport, right? And again, there are hundreds of those. So we're less concerned with what the total available land is in the country, and more concerned with specifically this is the land that we want to develop on. In most of those cases, we've actually been in the process of securing that land for years now, right? I mean, 4 or 5 years in some cases. There's a long gestation period in these processes, longer than I originally anticipated. It's also more complicated and more expensive than we originally anticipated. But it is, you're asking the right question. That is the binary threshold to this entire business, right? You want to build for cheaper, you want to operate better. There's, there are definitely, other metrics that you want to target, but the binary entry ticket is, can you get the land or not? Now, luckily, we started a long time ago, but this has been a much longer gestation period on average than we expected.
Given the comments on the economics of acquiring new land and that gestation period, I think it'd be a great time to talk about the total economics associated with building a new hangar. Would you talk about the costs, including, the rental expenses and regulatory, whatever? I mean, I assume there's some, logistical and red tape oriented costs associated with standing up a new hangar.
Yeah. Well, so I'll kind of give you back of the envelope, and our filings include a lot more detail. So if anyone's interested in looking at that, then definitely get deeper into economics. But once you get the land, remember you're sitting on a lease. You're not allowed to own land on a federally funded airport. Our average ground lease is about 50 years, but and we're happy with that. I think it's actually a good model for us to lease the land. So once you've acquired the land, figure it costs you between $250 and $300 per rentable square foot to actually put up our campuses. And so, and I use that metric of rentable square foot because it makes it much easier to think in terms of yield on cost when you do that. Obviously there's a lot of square footage we develop that's not rentable, right? There's apron where, airplanes taxi, there's car parking, there's a lot of stuff that's not rentable. but we think of it all in terms of rentable square feet. So depending on the jurisdiction, figure $250 to $350 all in development cost per rentable square foot. I can circle back later if we want to get into it on how we're trying to get those costs down, because that is a key thrust in the business right now. You lease that land on average at, call it $45 a square foot, triple net, and that's again a lot. If there's a little bit of variability, I said 250 to 350 on the construction cost. There's a lot of variability on revenue, right? It's real estate at the end of the day. It is a location game. There are jurisdictions where we get $100 a square foot, and there are jurisdictions where we're getting kind of high 20s, low 30s per square foot. But figure 45. I think our average today is probably a little bit higher than that. And then your OpEx is actually quite low. So we talked about that service offering, which it's very, very tailored. But a campus like the one you see behind me, can be managed by 5 or 6 people. It's 5 or 6 really seasoned people. It's not not just anybody who knows how to tow and fuel aircraft, but it's not an FBO that really requires many dozens of people in order to operate, because it has transient business. We've got no transient business. So figure about $6 a square foot per rentable square foot in OpEx, which includes those people's salaries. It includes our ground rent to the airport. It includes, any kind of ongoing equipment costs. All of that comes to about $6 per rentable square foot. So your kind of year one stabilized, we call it your first stabilized year of NOI, figure $39, $40 a square foot. That's more or less the economics of the business.
And obviously, if you're building new real estate, it's going to be capital intensive to some degree. So love to hear about how you finance these deals. And I also know that you've raised some equity. So you could talk about, where that equity is going to go. And then, I think at the tail end of this, love to hear, I think people worry about serial equity raisers and, what happens if the stock is low, you're still going to raise equity. There's getting a lot of questions. So love to hear as you think about the ongoing need for equity capital, given the raise that you guys have just done.
Yeah. Okay. Great. So the way we fund these campuses is yes, it's a mix of equity and then about 70% tax-exempt bonds. So let me start with the equity and kind of what the strategy has been to date on that. So we can start. So we had the first couple of years were really about validating the unit economics of this model. Like I didn't want to start trying to scale quickly before we really had our ducks in a row, and we're happy we did that. Like we made big mistakes. We knew we would make big mistakes. We just didn't know which big mistakes they were going to be. And the mistakes have got a little bit smaller, so we're now kind of surging ahead. So it's become about scale. But we had a pretty significant dilemma in 2021, which was accept a very large private equity investment, which definitely would have had the virtue of funding the company's development through the first 20, maybe 30 airports. So we would not have to think about equity capital for quite a while, but at the cost of very significant dilution to our existing shareholders and also management control. And the other opportunities what we ended up doing was going public, taking in permanent capital now, but a lot less capital. So we were consciously taking a risk that equity funding might not be available when we wanted it down the road. So I'd say we're happy being public, and we really deliberated for a long time. It was a small company at the time, very significant expense, and a lot of management attention, that we knew would have to be diverted to being public. But on balance, I think that's been really the right decision. One piece is keeping management control. I think retrospectively has been really key to our growth. We invented this space. We think we know it better than anybody. While we're, like I said, we are making mistakes, but we do think we're in the best position to make good decisions over time, and perhaps more importantly, quick decisions, which is great. Like the deal that we announced today, I think it'd be unlikely that we would have gotten that deal done had we been private equity owned. Had we gotten it done, it would have been because we paid, a real premium for it, which so we're happy with that. Also, we're here long term. We love this. We're all a bunch of retired military aviators here. We love being in the space. Having that permanent capital is great for that. It aligns our incentives, with our team members, with the airports, with aircraft owners. People know that we're here to stay, and it's a real commitment, and that's a differentiator here. We can talk about kind of who else is in the industry broadly, but that has been a differentiator. So we live with that risk that you highlighted, right? That the market's not necessarily going to be there for us when we need it. We've tried to keep up with the sort of maxim that you raise money when you can, not when you need it. So we've always been a little bit ahead of the game, and that's always it's I'm sure more art than science, and I don't know exactly how right we're getting it. But we've raised successive pipe deals at successively higher valuations, so that we're always slightly overcapitalized for the projects that we're currently contemplating. So they're definitely keeping a very close eye on cost of capital, and definitely don't want to be one of these companies that's permanently raising capital. We are funded at this point. We just closed the most recent pipe, which puts us way past organic cash flow break even, right? So this time next year, the company as a whole will be producing cash, which gives us the opportunity to be very deliberate about how we fund our future development. How much of it is reinvestment of proceeds versus taking in new equity capital. That really now becomes a function not of need but of timing, right? Do you want to grow aggressively? And I see, in one extreme scenario where you've got, like perhaps several $1 billion of development in front of you and the markets are there for you, great. Okay, raise a bit more capital. There's obviously also competitive questions, which I'm sure we'll get to as well. That should inform our kind of pacing of our growth. But fundamentally, yes, we do want to grow fast, but not at all costs. So having that ability would be a big deal. And then of course there's other scenarios where you have the opportunities in front of you, but the markets aren't exactly there. And one of the things that I think is interesting, it's a little bit nuanced, but there aren't really strict performance stipulations in airport ground leases. So that if you need a little bit more time to kind of get your ducks in a row in developing, and we've seen other people take 10, 15 years to do that. That's not what I'm talking about. But if you need a year or two, to get the stars to align a little bit better on the financing side, or as of next year, be in a position where you just need to wait and generate a little bit more internal cash flow to fund your next development. That's possible. Like, you don't really have a gun to your head on the development side. Again, that doesn't mean we don't want to grow fast. We do, but you do have some measure of control over that. So that's on the equity. Anything else you want to ask about the equity?
No, I'd love to hear. It would occur to me that being able to issue tax-exempt bonds is a nice competitive advantage that you don't see a lot outside of real estate, but in any public markets, right? Everyone else is raising corporate debt or something else. So talk to me a little bit about the debt financing.
Right. So our original financing this business, we were actually taking debt from a hedge fund, which was could be precarious, especially when you don't know exactly how things are going to kind of shake out in the business in the short term. I became aware of private activity bonds in the course of that kind of deliberation, in the early years, and actually very aggressively pursued the gentleman who's now our CFO, Francisco Gonzalez, who is kind of known as the guru or the rabbi of private activity bonds at Goldman Sachs for 25 years. And he had actually spun himself out to a hedge fund after that, but was very curious about our business. And in our conversations, made me aware of something called the ports exemption. By the way, just conceptually, a private activity bond is on a titular basis is actually a municipally issued bond. It is a government issued bond, but the de facto beneficiary of the proceeds of that issuance can be a for-profit company if you comply with certain criteria. And there is one large carve out which gives you actually a lot of operating room, which is called the ports exemption, where if you develop on maritime ports and airports, as long as you are compliant with the a pretty long list of stipulations, but it's static. I mean, you can configure yourself to comply with those. You don't have to wait for any sort of government approval for an issuance of those bonds. So and this was a bit of a risk to see that we could actually do this. And again, we didn't exactly have the equity to back the first issuance of bonds when they came up. We felt we could get it, but we weren't in that position. And 2021, 2022 was really kind of a critical breakout year for us in terms of financing, because we went public and we issued our first issuance of private activity bonds underwritten by Goldman Sachs. And those are extreme. I mean, it's really a powerful tool because it's, first of all, it's a very benign bond market with all sorts of really nice features that you don't necessarily get with other forms of debt. For example, the debt is fully assumable. If we do choose to exit this business at some point, the debt goes with it, and it's super attractive debt, which is why I kind of tell people if you're kind of projecting what NOI from a real estate portfolio will look like, and then attaching a cap rate to it, and maybe discounting from whatever year you do that into today, you might be missing part of the value of this company in that you've got this debt in place. We're paying about 4.18% fixed for over 30 years on the debt. If we issued today, we'd be issuing higher, but not much higher. It's really quite an exciting market, and you're doing that against an NOI stream, which again, I don't want to overstate it, but looks like a very steeply growing annuity. Right? You've got people, Fortune 500 companies, you have very, very wealthy individuals. These are very high credit tenants on long-term leases with very sharp escalators, right? Our leases escalate at CPI with a floor of either 3% or 4%, depending on the situation. And perhaps more excitingly is when we do get a vacancy, we've had, maybe not quite 10 of those yet in the company's history, but the average increase from the first term to the second term of the lease is 28%. So again, airport inflation is, I think, not something to be underestimated in this industry. So if you can attach a nicely growing annuity stream to fixed rate debt and just watch that spread grow year after year, it's super compelling. And so that's really kind of been an afterburner, this whole business.
There's one question left before we jump into the competition. I think we've already laid a nice foundation for why this is an interesting space to be in. So maybe you've talked about the financing, you've talked about a little bit about the cost. Talk to me about the hangars you've already built, what the payback times have looked like so far.
Right. Okay. So as you can imagine, it is pretty compelling. So if you're building, just kind of let's just run through back of the envelope. If you're building at let's call it $300 a foot, and you're making NOIs in the call it $40 a foot range, you're levering that approximately call it 70% loan to value. I think over time, perhaps we get a little bit more ambitious on those LTVs, but for now, we want to keep it very conservative, just kind of be the darling of this bond market to the extent that we can. You're talking about equity returns deep into the 30s, so that's a 3 year or less from the day it opens. Now roll that back 2 years from the day that you signed the lease. So it's kind of call it, 5 years since the day you signed the lease. And so far, call it 7, 10, 11 years from the day you identified the airport and started, so there's definitely a pursuit time here. Now, you don't have to expend your capital until, 2 years before. That's true. But there is, and again, that's perhaps one of the, and I don't want to say we wouldn't have got into it had we known that. And I'm very happy that a lot of those years are behind us on well over 100 airports. That's great, but there is a real gestation period.
And we talked about the FBOs as being kind of the traditional competition. So I want to dig into the potential future competitive set. So I think there's probably two streams. One, you mentioned Signature and Atlantic, obviously very large companies that, could in theory think about going from FBO to, kind of your model, but also these returns are attractive. There's endless money apparently for real estate deals in the US. So there could be copycats. So just talk to me about what you see as emerging competition and how you think about the risk of managing competitive entry here.
Yeah. Right. So I think you're right. If you're alluding to this, that the FBOs are not exactly competition. There is some overlap in what we do. Of course, they do cater to base tenants, so that exists, but it's really at the periphery. And I would say the business models are pretty close to mutually exclusive, right? And we've got a very close relationship with one of the big players. We do joint ventures all over the country that really benefit both of us in a big way. So the fact that we're competing at the periphery hasn't really gotten in the way of that. It's not the main event. And again, I don't, we have very open conversations. I don't see them getting into this business. You'd be parting from too much on your existing business, which is extremely lucrative. Sure. It's cyclical, right? The FBO business is highly cyclical. We're not. Right? Fuel is the most accessible lever you can pull in aviation in times of economic hardship or whatever pandemic. Just fly less. So fuel sales are definitely subject to a cycle. Rents, once an airplane exists, it's got to live somewhere. So that I think is much less cyclical. Copycats, I agree with you. I mean, it's we've been saying from the beginning that is inevitable, and perhaps one of the drawbacks, certainly one of the drawbacks that we deliberated on to being public, is that we've sort of published the recipe book, so to speak, for copycats to come and emulate. Haven't seen them yet. I mean, I see people out there with pools of real estate capital buying up existing hangar capacity. That doesn't really affect us. In fact, it's probably even a little bit of a positive. It's you're not changing the actual supply of hangars. You're just changing the ownership. And it's helped us in that in many cases you've got very, very seasoned, very local operators who've done some version of Sky Harbor on a local basis, but that really know how to operate because they've been doing it for a long time. And it's now owned by somebody who's more of a financial player, and perhaps I think provides less competition from just from a kind of a quality of offering perspective. And the second is we kind of like the precedent that these deals have set, is that it speaks a lot to our exit comps. These are deals we would not touch. I mean, they're very, very expensive. If you kind of if you projected from those deals as to what the valuation of the current portfolio at Sky Harbor, what that would be, it's a lot higher than we value ourselves, or the market values us right now. So I mean, those precedents are kind of welcome. I do think we're going to see real copycats. The fact that we haven't doesn't mean that we won't. That said, I'd make 2 points. First, it's very difficult to compete with us on existing airports. Like if you want to build at Nashville International Airport, we took all the available land. That's it. You can't. So there's a very good moat on the existing projects, which means you kind of want to be in this land grab mode and get as many of those dots on the map as you can. If for nothing else and for competitive reasons. There's plenty of reasons to do that. No reason not to. So we are aggressively looking to expand that portfolio. The second, though, is, I used to say, I even remember saying this in investor presentations, that, the moat is deep around existing leases, but the model itself is vulnerable to emulation. I think the more time that goes by, the higher that barrier rises. And, these are things that I maybe other people here didn't. I didn't really appreciate, exactly how difficult it is to get this right, and how much real empirical knowledge that's required. And it's not in the stuff that we file. It's kind of in the nuance of actual execution. There are plenty of ideas that we've put out there that people can emulate, but how do you actually get them, functioning in place, particularly in an environment where safety is a key? You don't get second chances in some of the things you do. It's got to be perfect. The business conceptually is very simple, but in execution, I think it's really it's anything but. We started talking, like, if you just look at the different vertical activities going on in the business. If you look at site acquisition, you've got to plant a lot of seeds, which we have. You've got to tend to those seeds very diligently and hopefully smartly. We continue to do that as well. And still, it takes years for anything to sprout before you see a result. That's on the site acquisition side. On development, to make it work the way it's working for us, I think you need scale, right? And we had the experience of doing one airport, our first airport. It's totally different doing it today, now that we're vertically integrated, right? We manufacture our own steel. We're not paying, these really sometimes exorbitant margins to metal building manufacturers. We've got a prototype design, which, again, you can look at it on paper and miss 90% of what makes it valuable to us. There's just a ton of nuance in there. So we have a factory in Texas that's stamping out the same hangar that was just designed over years, with really meticulously to fit every possible criteria that we could possibly fit. And now we're doing purchasing at a level that gets us advantageous pricing. We're increasingly looking at further integration, including some of the trades, bringing in some of the contracting in-house, getting to a scale today that's justified. Again, anyone who comes in, I think, has to build up. I'm not saying it's the only way to do it, but it's the best way that we've seen to do it. And I do think it takes time to build up to that. And then what we were talking about at the beginning is the service itself. Modeling that specific home-based service offering. Again, it's not an FBO's offering. It's very different. It's unique. Modeling that, staffing it, developing standard operating procedures that really work, hiring, training, controls, safety. All of that is not straightforward. And none of it's rocket science, of course, but there are a lot of little details that make it work. And then making it all work together, I would say, is almost its own vertical, right? It does have to all speak to your equipment list when you're setting up an airport has a lot to do with exactly how that airport's laid out. And right, so we've got 7, for example, campus layout prototypes that we use. We've got the one hangar prototype, but the way those hangars stack on a plot of land, taking into account everything from drainage to vehicle access to aviation traffic flow, security. There's a lot of different parameters there, which is why you can't exactly make the service work just anywhere. It's got to have a specific list of criteria. So we've learned, and we continue to learn through trial and error, sometimes painful error. And so, again, I'm almost sure we'll see other people coming in and doing what we do, but I think it might take a while for them to become kind of a potent competitors. There really is a first mover advantage in this space, we think.
And if one of your focuses is to build more scale, it seems like there's another outlet, which is the buy versus build opportunity, which you had an announcement today surrounding that. So talk to me about how you're thinking about the buy versus build.
So I'd say I'm surprised that we found a situation where we could buy. And look, we always have an eye on that because you never know, and things get shown to us all the time. We happen to be in a situation where, like I said, there's a campus. It's beautifully designed, really well built, and I don't even. Maybe we even inspired it. I don't know. I don't know where they got the original idea, but it's really designed like a Sky Harbor campus. And it's in a jurisdiction where I think for regulatory reasons, it would be difficult for another type of player to come in and make this acquisition. This was a distressed sale where it seemed that an FBO company would not have an easy time getting the appropriate approvals to do this. Just a real estate player that didn't have significant aviation operations experience would also face challenges like that, which left, I think, relatively few eligible contenders for something like this. So I was interviewed on this yesterday. It really was kind of an alignment of the stars. I don't think this is the rule for us. I think it's the exception. Again, we certainly would look, but most of the situations we see are priced at a level that's just not interesting for us.
I think one of the things that I've always worried about, because it's my job to worry about things with this model, is that being public and publishing your returns and being so, being such an evangelist for the value of this, is that, you start to get, some of your partners start to get a little smarter about the potential risks, or about the potential opportunities that you have. So why wouldn't, if I were a municipality, why wouldn't I turn around and say, you know what, I was charging you 45, or these guys were charging 45, but we're going to charge you 95. And maybe that works in the New York metro region, but that doesn't work outside of Austin or something like that. So tell me a little bit about how that part of the model is not, how you can control some of that risk.
Yeah. All right. Another good question. I'm trying to think how to put this in a way. There's nuance in the answer. I'm trying to say it in kind of a high level form, and we can get into it if it's interesting. But it relates to what we discussed earlier on, in that all of the airports that we operate on are AIP, Airport Improvement Program funding recipients, and in order to remain compliant with the FAA grant assurance guidelines, there's a lot of criteria that the airport have to meet. One of them has to do with non-discrimination on pricing. So because you can't really discriminate on pricing between the various operators on the field, the effect is that price adjustment is a much slower process than it would be, I think, under regular market conditions. You've got this sort of regulatory buffer. It's not that it doesn't happen, but what you would think would be kind of self-evident and should happen, very quickly, can take years or decades. So we haven't really seen a significant creep up in ground rents at airports. Now, look, there are other stipulations, right? There's minimum capital commitments. There's what the airport really wants is somebody. Again, it's not a business from the airport's perspective; it's an economic development driver, right? So to be credible, I could say that there are airports. I'd say when we started off, Dulles International Airport was a fantasy for us. There was, we kind of put that aside. There's just we're never be taken seriously. That's an airport that has such rigorous risk management, processes in place in their interface with developers on airports, and that could be anything from a vendor in the terminal, to a non-aviation use, like there's a solar farm that's using part of the land on the airport. They are extremely rigorous on that. So, and we wanted to be in the DC market because it's a fantastic market. And we actually started our process in several smaller airports, and Dulles is the reigning king. That's where business jets want to be typically, in Northern Virginia and Washington, DC. But eventually got to a place where we said, maybe we could take a shot at this. I mean, we're at Nashville International, we're at other airports, we've built, we've operated, we've got a bit of a track record here. Maybe we can, and we did, and succeeded there. That kind and being able to deliver like that, with very managed risk on the safety side, on the development side, is much more important to the airports than collecting more revenue for the land they're on. That seems to be pretty universal.
and I don't want to leave this conversation without discussing your largest shareholder, Boston Omaha, who helped you come public. I'm just curious about their current involvement. How involved are they? Obviously, they own a lot of the stock. So I just think anyone looking at this is going to wonder what is Boston Omaha thinking?
So Alex Rosick is the Boston Omaha board member at Sky Harbor, and he's been one of our most proactive board members. I'd say both the airport community and the aircraft owner communities they're smaller than you might imagine. Now, reputation means everything, and you can't establish that overnight, right? You have to earn it. You've got to keep earning it for sure. But having credible advocates to start relationships, people might start looking at you seriously earlier than they otherwise might. Again, they're not going to necessarily award you land or trust you with their $80 million aircraft, until you've really proven yourself. But they might be looking at you with a little bit more of a interested light. So relationships really do matter. And Alex has really just thrown open his Rolodex in a very active way. He stays on top of everything that we're doing, and any place that he can. And that's actually been quite critical. For example, I credit Alex significantly with that win at Dulles International. Again, it was his contribution happened probably a couple of years before we actually got it. But that's the nature of that's the nature of the enterprise.
And I also wanted to touch on technology a little bit. I mean, if I think from stealing from the Brad Jacobs playbook on how to make a couple $1 billion, fragmented industries that are capital intensive, but where technology is your friend. I get the sense that municipalities kind of being involved and the FBO is not really being technology companies per se. I'm curious how technology can be deployed here to differentiate yourself and maybe even expand the moat a little bit.
Yeah, so I think when most people think about technology as it applies to our business, you think of it in terms of being part of the offering. And look, we have an app that allows you to control all aspects of your hangar, including security and monitoring and all that sort of thing. The next version will allow you to procure services, concentrate billing in one place, for all things aviation. So there's a lot in there. And I don't know if you really call that technology. It's not some AI machine. It's an app. It's a good one. It works well. Serves our purposes. So on that side, I don't really think of ourselves as using technology. However, on the other aspects of the business, for example, mapping out a market. One of the things that we do is that we want to take occupancy risk in every market. We don't pre-lease these hangars, and we've got a bond market, with people like BlackRock and Vanguard as our bondholders, and we've got a very very strong loyalty to these guys for obvious reasons. We need to be really unassailable in our diligence on a market before we get into it. So our ability over time to cull data from a lot of different sources, everything from paid databases to satellite imagery to Google, to actually sending out teams to spend a month in a metro area and actually collect intel with their feet, which is often the best way to do it in certain criteria, and then stitch it together. And this very much reminds me of a classic intelligence operation. Stitch it together in a form that actually allows us to make much better decisions than we would otherwise have. So we've got these databases and tools that I don't think anybody else has. Measuring everything from break-evens for individual aircraft owners based on their usage patterns, their address, their home address, and their business address, whether they fly internationally a lot or not. Just a lot of different criteria, which allow us to say, okay, this is an airport in a metro center. Or first of all, this is a metro center that we like, and within this metro center, here's the airports. And our thinking on that used to be a little bit more brute force. which is, look, we love Los Angeles. We'll do anything in Los Angeles. Okay, that was good. But then it kind of got to, well, hang on, there's actually a ranking in Los Angeles, right? So Van Nuys, Burbank, LAX, Long Beach, there's kind of a ranking of airports. Let's go for the top. If we can't get the top one, let's go for the second one. And so we said, no, it's not like that either. I mean, that exists for sure. And if you were in a volume game, right, if you were out selling fuel like an FBO, that would probably be the only thing that'd be interesting to you. But for us, we're saying, hey, look, here's Camarillo, right? Here's the deal that we just did. We've got X number of spots available, and that's it, right? We can't handle anybody else. This is a home base. It's not a hotel. Here are the exact people for whom Camarillo is the best airport. It's better than Van Nuys. It's better than Burbank. And again, that has to do with a lot of different criteria. Let's have a word with a couple of these people, in advance. And great. So you do a much, much more nuanced, much better validation of the airport. And these are tools that, again, we've developed over years, and they apply everywhere, including, the leasing team, the operations team. There's a lot in there. So on the actual offering side, I'd love to be able to come up with something that really, makes fuel purchases on the road cheaper for our tenants or something like that. But that's where the tech is.
And I could talk to you all day about this, but we have to close because we're getting close to time. So I want to close with the question I ask all of our CEO guests. What do you think is the most underappreciated aspect of Sky Harbor as a company and an investment today?
Most underappreciated. Look, I think every company looks different on the inside than it does on the outside, not just us. So hopefully I say this with due humility. And I think, again, every founder sees his or her company, in a different way than you might from the outside. But as a company, this is an entirely new offering, and it's operating in a broad space that's seen very little business model innovation for decades. There's that. The company has a real warrior spirit, and it's not an accident that we're led primarily by military veterans. These are people who are out there. They seek contact in an industry that's kind of been dominated by a duopoly. So it's just a much more aggressive spirit here. And I think if you spoke to our industry partners, they'd probably tell you we're fanatics. And that's fine. We're aggressive, and we're innovative. And I think that's, we know what that's worth. I don't know if the market has quite factored that in, but we certainly know what that's worth. That's as a company. As an investment, look, if you're building a financial model for Sky Harbor, and we've seen a lot of outside financial models for our company, maybe the one area where I feel people don't spend enough time is on their inflation assumptions, right? Because we're running these out for a long time. If you're using CPI, I think that's a mistake. We've reported publicly on the annual escalation rates in our leases. I mentioned to you earlier what happens when a lease terminates and a new lease starts, and there's a major increase on that. So I would take a look at those. Again, they're out there in our public filings to help get people thinking about what airport hangar rent inflation is likely to look like. Because I would say, even that is only the beginning. Look, I feel that way about the whole enterprise. This is just the beginning. But that's what I would look at.
Well, Tal, this has been an incredible conversation. I think we've covered a lot of stuff. I appreciate every time and all your time, and I think people are going to be really interested in learning more about this story. And we wish you luck in your endeavors.
Ben, thanks for having me.
Thanks, Tal.
All right.